Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, and we are back once again talking money as, been doing it for a long, long time, all the way back to 1992. We've been talking money, and I'm excited about it always because, getting your finances straight, it's a new year, is one of the top most important things you can do to get stress out of your world and, do things, have a purpose that you're moving forward when you're working all the time. You get up, you work, you need to have a profit at the end of the week or end of the year. And so as we go through today's show, I'm going to call it Back to the Basics, thanks to my buddy Danny Brandon. He said you should do something called Back to the Basics and just build the foundation from the very beginning. And so when we go through this is another place that, if you're listening, you can go and hear this also via podcast at RoyMatlockJr.com or any of the different podcasts called the Roy Matlock Jr. Money and Business Hour. And we're going to go through and just kind of walk you through the basics and what are the basics of money. And then from there, I think you'll see what a plan matters and why it matters. And what I like to do is I like to automate financial independence. And what I mean by automating financial independence, you put in place a plan, you put aside money on a monthly basis, the money goes to different places, and you have automated your financial independence. You don't have to think about it anymore. You just know all I got to do is manage weekly, and I'll be doing good. And so we're going to go there. There's 5 key components that I believe that go into getting it set up. The first one is education and advice. So education, you have to understand. You don't have to be an expert. It's kind of like I met with a doctor one time and did a seminar, and he said, I do all my own stuff. I do it all myself. And I'm like, okay, you can do that. But, I don't think that if I Google about my health that's going to replace someone that does it all the time. So you don't have to be an expert, but you got to understand it to some degree. So how does it start out? So education and advice, you should be listening, reading, at least to be up to speed to some degree. I mean, you can't just go through your life completely oblivious to what's going on. So that's the starting point. And I've made my whole career in finance built around educating people. And it seems to have worked pretty good. I keep my clients educated, and as a result, we don't make nearly the bad decisions that you might would make without the education. Then we go into preparing to not lose. In sports, it's called defense. And the goal of the defense is to not let the other team score. And so what we want to do is not let the bad things happen and do everything we can to prevent life happening in a bad way. Then we go on the offense, and the offense is to grow wealth. It's where the majority of where we want to be is putting things in place once we get a foundation set up. Then we go out into the marketplace. I know that just through one of our custodians, Fidelity, they've got over 9,000 choices that you can invest your money in. So if you have 9,000 choices, which one? So then we match up products to the offense and the defense, and then we review and update it. And if you do that and you take a proactive approach to your money, what ends up happening is you get much better results. And so let's get started with some advice, and we'll begin with the GPS. What is a GPS? It's called the goal, the plan, the schedule. So the first thing I do when I meet with people is I want to find out, what would it be like if you were to quit right now and never had another paycheck, and all you're wanting to do is live off of your earnings? How much money would you need? All right. And if they want to keep include their Social Security in there, we can say, well, based on where you're at, your Social Security should be $5,000 a month, and we want $10,000 a month. So we're a shortfall on the goal of $5,000 a month. $5,000 a month is $60,000 a year. We say, well, what is $60,000 a year? Rule of thumb, we just multiply by 20. That's a simple rule of thumb, 16 to 20 times that. And we now have our goal. So $60,000, 20 times, $1.2 million. All right. So now we're there. And then we take and we say, but hold on a second. We are not going to retire for 20 years. And with inflation, rule of thumb, it doubles in 20 years. So now we go from 1.2 million to 2.4 million, and we now have a goal. We need $2.4 million set aside in order for us to quit and get our $10,000 a month in today's dollars. That's the goal. Okay. So now we look and we say, what have we done so far? And when I meet with people, the first thing I do is I find out, your current state of affairs. And we take your current state of affairs and we look at how we can optimize the current state of affairs, meaning that you've got some debt or you don't have debt, you got a house, you got equity, you got whatever you saved, all that kind of stuff. We look at where your money's at. We say, well, we probably could reposition this, get a better rate of return. Maybe you're too aggressive, maybe you're too conservative, whatever it may be. And we then take and we box that up. So that's the first box, or the first part of your money is where have you gotten to from the start. So if you show up to meet with me or one of my advisors, first thing we're going to do is we're going to say, let's check out where you're at. All right. And we find out you've got this and this and this and this and this. And then at that point, we look and we say, here's some advice on what I would do with what you're doing now. All right. We now have what your goal is. We know that you want to have $10,000 a month when you retire. We know the number is 2.4 million. We know that you are currently sitting at this. You've got a few issues there, like you're not fully, taking advantage of your deductible 401k or your matching funds or whatever it may be, or maybe you've got, some money sitting in the bank, getting very little, but you still have credit card debt sitting there that you could just pay the credit card debt off with, or whatever it may be, or you got a car. Well, it could be a number of things. But you've got some 401ks that are sitting at a previous employer and, that you don't know what they're doing. I mean, there's it was so many trillions that I read that I was reading an article about just on 401ks that people don't even know they have. All right. And we can help you find those things. So then once we've done that, we go into the plan. And the plan is we're going to do this and this and this, and we're going to put aside this much money per month because this is what you need to do. And we're going to disperse this money into all the different places that will allow you to get where you want to go. And then we have a schedule. Our schedule's 20 years. So we start with the basics. That's the GPS. And then we start moving into understanding and getting all the education. My name's Roy Matlock. And if you want to visit us, visit RoyMatlockJr.com. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, I'm back. Roy Matlock Jr. We're going into our second segment today of Back to the Basics, and it started with the GPS, your goal, your plan, your schedule. The first most important thing you can do is find out what is the end result, that you need to have. Otherwise, you just wake up and you're like, I don't know where I'm going. I think I'm just going to drive my car and have no plan of where I'm going to get to. And hopefully I'll end up getting where I need to go. And that's why I call it the GPS. With your money, it's your financial GPS. And then if you have been tuning into my shows, you can go to RoyMatlockJr.com. Actually, if you're listening now, the prior week we did a whole show. I did a whole show just on the budget, on how to set a budget up for the new year, because you got to have income and outgo, and there's got to be a gap, and that gap is your quality of life. And so you want to have a great quality of life, and you want to have a big gap between your income and your outgo, and then you put aside money, and then every day you put that money aside and you start looking at it. You're like, man, this is good. I'm moving forward. And so we do that, and the budget is the starting point. I'm not going to get into budgeting today because I did a whole show on that, on how to set up a budget. Then we're working on the defense. We have an emergency fund. How does the emergency fund work? Well, it's 3 to 6 months of liquid cash. Most people say, well, why do I need that much money? Well, it's the fund that is set aside. Your rate of return is low as it relates to interest, but as it relates to what you can do with it, here's what it allows you to do. Number one, you can have the emergency fund and raise your deductibles on your homeowner's insurance, your car insurance. You can do the same thing with your health insurance. If you're buying health insurance or doing a health share, whatever it may be, that allows you to reduce costs there. That frees you up money to save. The emergency fund is for things like that. In the case with me, I've generally speaking, only carry liability on my car because I know I can take the risk of if something happens. So that saves me a lot of money. I think I had a $200 a month that I saved just on car insurance because I had the cash, and do I want to total my car and take the hit? No, but you know what? I can. And so you do things like that. Then we go into debt management. We determine, what is good debt, what's bad debt. The first rule of thumb on good debt is you can afford it monthly. All right. If on a monthly basis, you're stressing all the time because of the amount of money that you're paying in debt payments, and that would be the first sign that you're overextended. And then we start looking at how do we fix that. I remember back in the 80s, right when I got into the financial business, I didn't know what I was doing, and I'd already put myself into a bad spot. I had car payments and stuff like that, and finally when I figured out what was going on, and I was upside down, and I thought it was a big deal, I bought 2 new cars at the same time, got married, 2 new cars, bought a house, and then I'm sitting there wondering what I'm going to do to pay for it all. And then one day I was like, I'm sick of this, and I'm going to get rid of this. And so when I finally got from being upside down in the cars, I sold the 2 new cars, bought 2 used cars, really old used cars, and ended up paying them off in a year rather than 5 years or whatever it was. And that was the last time I dealt with car payments. And so what happens is you start looking at the debt and you say, what is good debt? Good debt is you can afford it. It also is tied to something that appreciates. So you never want to finance depreciating items. If they go down in value, you got to pay cash for it. It'd be like you're going to dinner and you got a credit card balance and you pull your credit card out and you say, I'm not going to pay cash tonight. I think I'm going to finance it for 30 years, my dinner or my vacation or stuff like that. So what you want to do is just look at anything that goes down in value and you've got debt tied to it, bad idea. All right, so that's debt management. That allows you to always pay it when you're looking at your home purchase. Never pay a bunch of closing costs when you refi or if you buy a house. Always go with a higher rate and do par. What that means is that I don't want to pay a bunch of cost and then rates drop and I'm deep into it with cost. So what I'm going to do is I'm going to go with a higher interest rate, and then I will refinance to a lower interest rate. And when I refinance to the lower interest rate, I walk out of the closing. If I owe $300, I want to owe $300 again when I walk out. I don't want to owe $310 or something like that. And so that's debt management. Then we buy life insurance. We got temporary insurance, and we got permanent insurance. What are the differences? Term is the cheapest that you can buy to replace your income. We buy income protection. Rule of thumb, take your income, add a zero to it. That's going to give you an amount of money, about 10 times your income. So if you're making 60 grand, chances are 600,000. That's just a simple basic rule. You can look at it and do a little bit more calculations, but that's the starting point. Then you might add something. You say, well, I want to pay my mortgage off in addition to that, or maybe provide for my kids' college, whatever it may be. But the rule of thumb is 10x. You need that in income protection. You also have permanent coverage. The one that I recommend is called indexed universal life. How does that work? It works like this. It provides you an ability to develop cash value as you get older. If you want to get to that cash, you can pull it out as a loan, very similar to if you were to have a stock portfolio and you did a margin loan. You are able to get that money out tax-free, and then it stays with you for as long as you live, and then you have something for final expenses. The other insurance on life insurance would be just purely if you're older, something to clean up, expenses. And what do I mean by that? Well, typically they say it's about 50 grand between medical and burial and all that kind of stuff. And if you're married, you lose one of your Social Securities. And so that's the idea behind getting and keeping something at that at an older age. Now, if you're wealthy and you've got plenty of money and it doesn't matter, you may decide to not go with life insurance when you're older. Then we look at health insurance. We know everything that's been going on with health insurance, but the most important thing is you have something. I tend to go toward a health sharing program. There's a number of them out there. We have recommendations on that. And what health sharing does, it's very similar to when I was my daughter, who's 33. Back then, you paid to have maternity benefits extra. And I looked at it and I'm like, you know what? This doesn't make a lot of sense. I mean, why am I paying? It's just a savings plan. So I went to the hospital prior to delivery and I cut a deal with them and paid them cash and got a big discount on it. And that's how health shares work. And so we're going through the basics right now. I call it back to the basics. So if you're listening, you're going to get the A to Z of money today. And visit RoyMatlockJr.com. We've got some upcoming events and webinars to start the new year off. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
Right, we're back in segment 3 of our Back to the Basics radio show and podcast. You can listen to all of these. I think we're up to about 180 of them at RoyMatlockJr.com, or go to Apple or any of the different places that you listen to podcasts, and you can get your financial education. That's what my goal is to educate the public. I'm a financial advisor. I have advisors that have been with me and helping people for years. We have a big client base, a lot of 5-star reviews. So if you need help with your money, visit RoyMatlockJr.com and do a free call and see if we're a fit for you. Let's keep going. So we have hit the basics: GPS, that's your goal plan schedule, budgets, emergency fund, debt management, life insurance, health insurance. Now we'll talk about disability insurance. That's insurance in the event that you can't do your job anymore, and you can buy those policies. A lot of times they're stuff you can get through your employer, but the bottom line is that it's an income protection plan. And so when we buy insurance is either protecting assets or income. That's the way you look at insurance. All right. And so I'll give you an example. Life insurance protects your income. That's what term insurance does. And so generally speaking, life insurance is for income protection. It's also okay, to protect your assets in the event that you die. You don't want to be selling stuff and things like that in order to pay for funerals or it's medical expenses, stuff like that. Health insurance, okay, is asset protection. All right. So what that means is that you get a big medical bill and you don't have it. And so then you got to deplete assets or problems like that. Then we go to liability coverage. Disability coverage first, and disability protects income. Liability protection is asset protection. So, for instance, you have a wreck and get sued. I had that happen to me. Coming home one day, I went down to Memphis and took my son to the Grizzlies game, and we're driving back, and the traffic stopped, and he was snoozing in the back seat, and I looked around, heard something. It sounded like it spilled, and my foot came off the brake, and I idled into this delivery truck. And boy, oh boy, you would have thought this. I mean, my little car rolling into a delivery truck. Oh, he had back problems. He had this. He had that. All that kind of sued me for $500,000. And I think it was because, I had a Mercedes and, he's like, oh, I'm going to get this guy. Well, I had my personal umbrella policy along with I had plenty of liability insurance. And the insurance company called me and they said, what happened? I told them, they said, can you send your cell phone records to make sure you weren't, actually not paying attention, you're on your phone? Yeah, I can do that. And then I met with the lawyers, the attorneys paid for, and did that one time. And about 2 years later, guess what happened? They settled. They gave them a little bit of money, and it was the end of it. But the point being is people are always out there. So if you get sued, somebody falls off your back deck and you get sued, you have liability coverage. I recommend personal umbrella policy. It's a cheap lawyer. Get $1 million umbrella policy, $2 million umbrella policy is an asset protection. We look at our mortgages. I've spoke on mortgages already in the show, but when you're borrowing money, front-end fees are amortized out over the life of a 30-year loan. So when you pay front-end fees, more than likely, especially in the interest rate environment now, which are kind of at higher rates, chances are you may want to refinance or sell your house. All those fees are amortized over 30 years, not over 3 years or 2 years. So I see people all the time, they go in, they pay huge closing costs, points, all these kind of things, and then they end up selling their house a few years later, and their 4% loan was really a 7% loan for the length of time that they borrowed the money. Reverse mortgages have a place. If you are a retiree, chances are you've got a lot of equity in your house. I see it all the time. The reason people have equity is they were forced to have equity. The reason they don't have money is they weren't forced to save money. And so that's part of the pay yourself first mindset of automating financial independence. So you'll have money, but the long and short of it is reverse mortgages, they're called HECMs, home equity conversion mortgage, and it allows you to get cash out of your house or even to pay off the monthly payment, which will allow you as a retiree, 63 and older, to be able to access your equity and not give up your house. And so we have a referral partner that we have been working with. I've been recommending this in certain instances for, 10, 12 years, something like that, on the mortgage side. I have a mortgage license, and I understand it, and I think it's a good play for depending on the situation you're in. Your home purchase should be about 20% monthly of what you are earning. That's a good conservative number. If you go in and say, well, can I do a 15-year mortgage? Benefit of a 15-year mortgage is you usually get lower rates, but the main thing is if you can't afford the 15, you're buying too much on the 30. And that's kind of the easy way of understanding your home purchase. That is the defense we have covered so far. Advice and education, understanding things, simple little bullets, okay, that cause you to become financially independent. We take everything that we've done, we make sure that we do not go backwards. We have a great defense. We go on the offense. What is the offense? Well, the offense is wealth creation. How do we create wealth? Well, the first thing we got to do is got to get our money working for us, and we got to contribute to our money growing. And the way you contribute is you take a piece of your income and you set it aside so one day you can live off your assets. So how does that work? My rule of thumb is 10% is the starting point. If you have 10% of your gross income, I'll give you an example. If you're making $100,000 household, 10% is $10,000. We would take that $10,000, which is $833 a month. Half of it we go toward defense. The other half will go toward the offense. If you have 15% set aside and you're making $100,000, that's $15,000 a year. We would take the 5%, which is about $400 a month. It would be going toward your defense, and then the other 10% would go toward your offense. So typically 10%, 50% of it's going to the defense and 50% to the offense. As you continue to move forward, you earn more money, you reduce debt, you do things like that. Now you're saving 10%. Then what's going to happen is our 15%, we're going to take 10% going toward the offense. So rule of thumb, half defense, half offense on a 10%. The rest of it, anything above that, we go pure offense. Now let's talk about what are some key elements to the offense. Number one is pay yourself first. You have to automate it. And what I mean by automating is I had 11,000, I think, I don't know what the count is at this point, 11,000 people that had a draft on their checking account each month going into investments. Think about that. 11,000. We want to, I believe with everything that's in me, that you automate it. You pay yourself first. What you do is you set up your plan. All you have to do, and it just blows my mind. I meet with people and they don't even max out their 401k where they're getting matching funds. They don't even get the match. They don't even do it. And I'm like, hold on a second. You put in 6%, they match you 3, that's 9, and you deduct the 6, that's ballpark 5. Somebody walks up to me and says, hey, hand me, I hand them $5 and they hand me $9 back. I'm like, nah, I don't want to do that. That's a bad idea. Here, I'm going to hand you 5, and you just give me 5, and I'll give you 9 back. Nah, I don't want to do that. That people, come on, okay? So we set those things up to automate. And so first thing we do is we automate. Now, if you don't understand where to invest it, let me give you how you do it. Almost every one of them, retirement plans. All you do is take your birth year and add 65 to it. Go find one that says lifestyle or target date or something like that. That's the go-to. That's how you pick your 401k if you don't have anybody helping you. So we do that. We pay ourselves first. If we don't have that, we're going to do IRAs. Or if we do have the 401k, I like to do what I call retirement plan stacking. What is that? So we go throw, $20,000 into our 401k. We get our match. We get a deduction. The deduction, if you're in the 25% tax bracket, is $5,000. The $5,000, we toss it into an IRA. All right, and that's a free IRA because we've got the tax deduction. So now we're paying ourselves first, then we're going to go to compound interest and start getting that moving. We're back to the basics. That's what we do here every weekend on the Money and Business Hour, teach you about money. My name's Roy Matlock Jr. Visit RoyMatlockJr.com. We'll be right back.
Welcome to the Roy Matlock Jr. Money and Business Hours, where he'll help you fix your finances once and for all. To reach Roy, call 615-843-2999. That is 615-843-2999, or visit RoyMatlockJr.com. Now, here's your host, Roy.
All right. Final segment today. I don't think I'm going to get through all of this, so we'll continue it the following week on the Back to the Basics. It'll be Back to the Basics 2. So we're Back to the Basics 1. We've talked about setting up the defense, and now we're going into the offense about paying yourself first. And so rule of thumb, you want to start get to 10% right off the bat. And I'm going to give you an example. So let's say that you're making you've got $1,000 left. All right, and you're going to take that $1,000. You've paid all your expenses, and you got $1,000 to automate. And what I mean by automating, we're going to put it into things that cause you to be safe. In the event something bad happens, we do that, and then we're going to put the other half of it out of that $1,000 into something that's going to grow. All right, so let's take a look. So I would set up a term policy, term life insurance policy. I would take advantage of any kind of health sharing that I've got through work, which is a deductible health savings account, that kind of HSA. That's a deductible account for your health insurance expenses or health expenses that you spend money on. It turns into a retirement account as you get when you reach 59 and a half. Here's the other thing about one of those HSAs. You can take a portion of it and put it into growth funds, all right, once you have a foundation there. So we do that. We're going to buy a life insurance policy. It's a permanent life insurance policy. We're going to set that up. We're going to put aside, do that. And also we get our will and trust. All right, so now we got kids. I can tell you story after story after story on that. If you don't have that set up, even like you're teenagers, if you don't have a health, I say 18 and up when they're an adult, if you don't have their if you don't have a power of attorney, healthcare power of attorney, something happens to them, you can't even make decisions. And so anyway, we do that. So that's that. Then we're going to take the other half. We're going to focus on 401k. If you have it, if you're self-employed, we're going to do some, potentially a single 401k or a SEP account. Either way you look at it, we're going to match and deduct and do that. Then we're going to go in there and get our money working for us. And we start with an automated savings plan, either the retirement plan through work or you're doing it on your own. We compound it by taking advantage of taxes, some tax deductible ones that allow you to free up cash in order to put into maybe a Roth. I like to call that retirement stacking. We start working on understanding compound interest. What is compound interest? If you understand the rule of 72, rule of 72 says this: take any interest rate, divide it into the number 72. It'll tell you how long it takes your money to double. So if you have your retirement plan sitting in the bank at 1%, in 72 years, your money will double. So if you put in $1,000 in 72 years, it'll double to $2,000. That's not a good plan. But if you go and get 10%, it's going to double in 7.2 years. So now it doubles every 7 years. So in a 30-year period, you've had 4 or 5 compounding periods where it doubles. All right, if you get 10%, it's 7.2, 12% is 6 years, 6% is 12 years, and so on. And all you need to do is just take 3 numbers and say, I've got $1,000 and put it over here. I get 4% and it doubles in 18 years. And I look at it and I say, oh, here's what I got. All right. Now, if I could get 6%, it's going to double in 12 years. This is what I got. If I get 10%, this is what I got. 12%, this is what I got. And you start looking at it, you say, well, now, why would I want to have my money double in every 18 years if I could get it to double every 7 years? All right. And then we start picking and choosing where we're going to put that money. And so that's some of the stuff we do. We do investment advisory to get you better rates of return, hopefully by better diversification, better choices. All right. In doing that, we then get on a consistent basis and give it time. Best way to get rich quick is to get rich slow. All right. That's it. The slow, steady compounding, and one day compound interest kicks in for you and you're good to go. So time and consistency, we set up a time to where we have a goal. That's part of the GPS. We then begin diversification. When we're younger, we tend to be more aggressive on long-term money, which allows us to get maybe better growth, what's called dollar cost averaging. And the idea of dollar cost averaging is you take advantage of down markets. So when you're retiring, it's called negative sequencing. So you don't want to be in more aggressive things because of the possibility of the market going down, and then you're having to sell more shares in order to be able to get your income. But when you're buying, you want to be able to buy more shares when the market is down. That's called dollar cost averaging. So you go in, you say, I'm not worried about what the market is. I'm just going to buy every month with the idea that my average share price, I'm going to pick up some times when the market goes down. For instance, back in 2007, all the way to 2012, when the market was going down, your lump sum you weren't that happy about, but if you were buying in your retirement plans, that's when you made all your money. And so you're buying in the down market. We will diversify across different types of fund classes. You got stocks, bonds, you got money markets. Then inside of there, we got large, medium, small cap funds. We have growth in income. We have international funds that invest outside the U.S. only. We have global funds that will invest not only outside the U.S., but inside the U.S. And so we get fully diversified across all different types of classes with the idea you're not putting all your eggs in one basket, and that gives you more diversification. As we get older, we diversify into annuities. Annuities are for the mostly for longevity, has some stability. Longevity means that you live to be 101 like my mother, and you don't run out of money. Annuities provide lifetime income guarantees, and that's what a lot of retirees do. We put a piece of it into something like that. We look at cost, all right? When we're doing things, I like to put people in lower cost investments, and the idea behind that is the less cost, if they're still performing properly, is money back in the pocket of the investor. And if you do good, I do good. That's the way I get paid. I get paid a percentage of the value of the account for as long as you're with me. So if we do good, you stay, I'm happy, you're happy, you've got more money going. That's how we operate. It's called a fiduciary. And so we get, we take our income goes down. If the market goes down, our income goes up. If the market goes up, if you add more money, we make more, you make more. That's good. So that's the idea behind fees, and we look for low-cost alternatives to do that. Then you can get mutual funds, or you can have ETFs, you can have managed accounts, and different things like that. So let's talk about what is a mutual fund. Well, a mutual fund is we mutually fund it. How about that? You and I and everybody else can throw in a little bit of money into a big pool of money, and that big pool becomes mutually funded, and then a professional money manager who is, yes, the person that sits there and pays attention to your money. That's what they're trained to do, and they go out and they look for the best options, all right, that they can put your money in, and they put it across a lot of different things. So you're getting your diversification inside of there. As a result of it being so big of a fund, they can charge lower cost to you than you trying to do it on your own, kind of deal, and that's how a mutual fund works. Now, funds tend to be for smaller investors. You can get into a mutual fund for $50 a month. Even today, you can open one up. I've got one that has been around for 50 years, and it's beat the market, and you can open it for $250 and add any amount of money to it that you want. I tell people, if you have children, get one of those funds. Show them how a checking account works, get them a checking account, and then show them how to put money in whenever they have extra money. They can throw $20 in or $5, whatever it is, and you're teaching your kids about money. We have a thing called ETFs. ETFs are exchange-traded funds. The difference in a mutual fund and an ETF is a mutual fund is priced at the end of the day, and they add up all the value of the individual holdings, and they have a price, and it's priced at the end of the day, not during the stock market. An exchange-traded fund might be a pool of companies that, depending on what they want, maybe you want self-storage space. You think self-storage units are that, you can buy an ETF that only invests in that, and it's traded throughout the day like a stock. A managed account is where you go into, that's called a fiduciary account. That's where it's a fee-based account. So, for instance, you might pay 1%, and that 1%, the financial advisor connects you with different funds, ETFs, whatever it may be, and it doesn't matter if they move it around or not move it around. At the end of the day, your cost is the same, so there's no benefit for buying and selling unless it's to get the account to grow. So now we've done that. We have asset allocation across all these different places. We now are in a scenario where we know where we're going. We have a consistent monthly amount of money. And I want you to think about this. So let's say you had $1,000 a month. This is just an example. And you said, what if I knew that out of that $1,000, we could automate a plan that would get me where I want to go? And all I have to do is just make sure that the $1,000 is in there every month. And then they snatch it out of your account. They send it here, send it there, out of your paycheck, whatever it may be. And you know what you're doing. You would wake up and say, man, that's pretty good. I feel better about that. That's one thing off my plate I don't have to worry about, is I have a plan that based on these interest rates, if I just keep that $1,000 in there, this is where I'm going to be in 20 years and in 30 years or whatever it may be. And I know I'm okay. And you just rest. You say, that's one thing off my plate. Now I think I'm going to go figure out how to lose some weight or something like that, or work out or whatever it may be. But you got that money thing off your plate. that's good. That kind of goes along with getting off your plate. Maybe that works too. But anyhow, with that being said, then we've got a plan. We're going to and we're going to decide to cut our taxes. All right. So how do we do that? Well, we take advantage of retirement plans. We turn around and have money. If we have money, a lot of money set aside that we're not using, we're going to put it in something that's tax deferred. So we don't want to pay taxes on money we don't use. That's one of the rules of that. And then as we retire, where do we pull from in order to be able to get the best taxation, with the idea that maybe we don't have to pay taxes on the Social Security that we got taxed on to put in there to begin with. And so your tax planning comes into big play when you are pulling money. All right, well, we're out of time. My name is Roy Matlock Jr. We are financial advisory. That's what we do. We teach people money, help people with their money. If you would like help, would like to do a short phone call to find out if we're a fit, visit RoyMatlockJr.com or dial 615-843-2999. I'll talk to you next week.